Good morning, everybody. In the interest of time, I'm going to get started, but thanks for coming along today to our South Australia housing market update. If you've got any questions as we go through, please put them into the Q&A function at the bottom of your screen, and we'll do our best to answer them at the end of the presentation. But right now, let's hop into it. I'm going to start with a bit of an economic update, just to give you the lay of the land and what we're seeing at the moment across the country. So if we start with economic growth, you can see here that the economy is growing at a really sluggish pace. Economic growth was only 1.1% over the past year. The long-term average rate of economic growth has been 3.1%, so it's less than half what has been typical over the last 30 years. You can also see that economic growth has slowed quite significantly over the last 12 to 18 months. If we look at economic growth on a per capita basis, GDP has been falling for 4 consecutive quarters. And in the history of the data that we have on a quarterly basis, which goes back to about 1973, we've never seen 4 consecutive quarters in which economic growth has fallen. So it really does highlight how weak the economy is at the moment, but also the fact that we've got really strong population growth is the main thing propping up the economy as we speak. If we then move to other data which is contained within the national accounts, you can see here the household saving ratio, and it's sitting at 0.9%. Now it dropped a little bit, but it's not as low as it was a couple of quarters ago. But you'd have to go back to before 2008 to see the household saving ratio as low as what it is at the moment. And you can see also that it's well below its 30-year average rate at 4.8%. What happened over the last couple of years? We saw a huge amount of savings taking place during the pandemic, largely because it was very difficult to spend. You couldn't travel, shops were shut, people weren't going into the office. So people weren't spending money, they were saving quite a lot. Now, obviously, inflation's gone up, the cost of living is a challenge, and households aren't as able to put away as much aside each month, and we're seeing very low levels of savings at the moment. On the right, you can see household consumption, which is basically just household spending, and again, it's below the long-term average. Household consumption accounts for about 50% of all economic growth, all economic activity, I guess you could say. And over the past year, household consumption has grown by 1.3% compared to a long-term average growth rate of 3.2%. So households are really tightening their belts and spending a lot less in this cost of living crisis we're in at the moment. We then have a look at inflation. Inflation has been the biggest headache for the economy over the last few years, and over the last quarter, inflation was actually stronger than expected. You can see that inflation has trended lower, but there was this uptick in inflation over the quarter, and this is why there was a lot of speculation that the Reserve Bank may need to lift interest rates. Of course, they didn't, but if we get another surprise increase in inflation, there's a stronger likelihood that we could see a further interest rate increase. Some recent modelling suggests that all of the energy rebates that state and federal government is giving and the cost of living relief will actually see headline inflation fall below the Reserve Bank's target range of 2 to 3% over the next few quarters, but then it will rebound to higher once all of those support payments are taken out of the system. But the big challenge is that inflation remains outside of the target range. Underlying inflation, which is the Reserve Bank's preferred measure, is expected to continue to remain outside of the target range until the second half of next year. So inflation is obviously still problematic at the moment. The cost of everything is going up quite rapidly. If we have a look at what's driving inflation at the moment, you can see that services inflation is the key driver at the moment. It is proving much more persistent. Now, that's not just an Australian thing. That's something we're seeing right across the world at the moment. If we have a look at the components where we are seeing that stronger rate of inflation, insurance costs have gone up a lot because housing costs have gone up a lot. So the cost to replace a property is significant. Also, there's at least indexation to inflation, and we've had high levels of inflation. Plus, you've got climate change and things like this, and natural disasters becoming more regular. You've got education. Education is a service. Education, HEX, is indexed to inflation. So we've had high inflation, so education costs have gone up a lot. But we've also seen really strong demand for education services because of the rapid rebound in net overseas migration. Housing costs have come down from where they were a year ago in terms of their rate of inflation, but rents are still rising really rapidly. And you can see alcohol and tobacco indexed to inflation, excise twice a year. So alcohol and tobacco costs are going up quite a lot. Now, you'd have to question whether any of these would actually see weaker growth if we had higher interest rates. And you'd probably say no. You can see the areas that things are really starting to moderate inflation, communication, furnishings. Higher interest rates are certainly playing their part in slowing down inflation in those segments. So the cash rate at the moment is 4.35%. You'd have to go back to 2011 to see the cash rate higher than it is at the moment. So it's the highest cash rate in 12 years. And obviously, we've had a very rapid increase in interest rates over a very short period of time. But interest rates have been on hold now since November last year. And the base expectation is that interest rates will remain on hold, with the first cut not expected until the middle of next year by the market, as shown by the cash rate yield curve there. If you even go back sort of 2 or 3 months, the expectations were that we were going to get interest rate cuts around September, October this year. So the expectations of when cuts are going to occur has been pushed way back, and it's going to be interesting to see how households respond to that, the fact that we are going to have higher interest rates for longer. The labour market, though, it's been really the strong point of the economy. You can see here that at the moment, the unemployment rate is 4%, and it's been below or around 4% for about 2.5 years. Between 2008 and 2022, we'd never had an unemployment rate below 5%. So that shows you how tight the labour market is at the moment. You can also see that the participation rate, which is just the percentage of the adult population that is working or looking for work, is pretty much at record high levels as well. There's 2 ways to read that. It's, is it the strong opportunity for jobs that is driving more people into the workforce, or is it the cost of living crisis is driving people that didn't need to work previously back into the labour market? And then you can see that the job creation is still strong and still stronger than that 30-year average. But we have seen a slowdown in job creation, and job creation now is much stronger for part-time employment than it is for full-time employment, which again indicates some weakness in the labour market. Other measures are highlighting what's happening in the labour market. The underemployment rate is trending higher, as is the underutilisation rate. So the underemployment rate is the percentage of people that are employed but would like to work more hours. So that could be someone part-time that wants to be full-time, or that could be someone that's 20 hours a week part-time that wants to be 30 hours a week part-time. So that's trending higher, and the underutilisation rate is the combination of underemployment and unemployment. Both are well below their 30-year average levels, but both are trending higher. And you can see that there has been a big slowdown in the annual change in hours worked as well. So again, that reflects the stronger growth in part-time employment than full-time employment, that hours work is reducing or is growing at a much slower pace. So there's definitely signs of some weakening of the labour market, but things are still very tight. You can also see those signs when we look at the number of online job advertisements, which are down 21% from their peak, and they're down 15.5% over the past year. In saying all of that, South Australia has only seen a moderate decline in online job advertisements, down 6.8%, much more moderate than when you look at places like New South Wales, Victoria, and the ACT. And because the labour market has been so tight, the wage price index has seen quite strong wage annual increases. So at the end of last year, the wage price index was up 4.2%. In the March quarter, it was up 4.1% over the past year. So it has rolled over, but you'd have to go all the way back to 2009 to see wages growing as rapidly as they are at the moment. Now, this is probably going to be the peak of wage growth, but for the last 2 quarters, annual wage growth has been stronger than annual inflation. So households, for the first time in about 3 years, are actually seeing some real wage increases, which means that you feel like you're not falling as far behind as you were when wages were growing, but at a much slower pace than inflation was. Moving on to the lending environment. So over the past year, you can see here that new mortgage lending is up about 25%, and refinance lending is down 16%. Refinance lending has dropped because fewer people are shopping around for better mortgage deals. A lot of people that came off fixed rate mortgages did so in the first part of last year, and that's been a lot quieter since. But also interest rates are not changing as regularly, so fewer people are shopping around. New lending up 24.5%. So if we have a look at what's driving that, investor lending is up about 35% over the past year. Subsequent buyer lending and first home buyer lending is up about 18%, both of them over the last 12 months. So there has definitely been a rebound in investors, but a rebound right across the board as well. And you can see that it's been quite a quick shift higher in new lending. Now, of course, this is based on value. So it's a combination of the price people are paying and the amount they're borrowing, but also the volume. And we are seeing the value rise quicker than we are seeing the volume of new loans rising. One of the key challenges around building new housing at the moment is how much more it costs to build a new house. So there's two parts of this. There's the input prices, which is all of the materials you can see there on the right. And since the beginning of the pandemic, those prices are up about 34%. You can see that the annual rate of growth is slowing. It's still growing, but at a slower pace. And then you've got the outputs, which is actually things like the civil construction and the actual building of a new house or a new apartment. And you can see that through the pandemic, the output costs for houses have increased by about 45%. Worryingly, they were slowing and they've ticked a little bit higher on an annual basis. The output cost for other residential, which is units, has increased by about 24% since the pandemic, so more moderate increase, but you can see that there's also an escalation there over the last couple of quarters, and those prices are up 7% over the past year. What does this all mean? This means that the cost of a new home is much more expensive than an existing home. Now, there's always a premium for a new home. That premium is much wider than it has been historically. And what that means is people are preferencing buying existing homes rather than new homes at the moment, which means it's harder to get enough pre-sales to go ahead and build the additional housing we so desperately need. And if we have a look at how that plays out, you can see that dwelling approvals have dropped a long way. Annual dwelling approvals are pretty much the lowest they've been in 10 years. So why are dwelling approvals down? Well, firstly, the cost of housing construction is up, and that makes it harder to get pre-sales. Higher interest rates also make it harder to find enough people to buy properties, but also it impacts on the viability of new construction because developer finance and construction finance is much more expensive. So it then becomes a challenge to make these projects stack up. I mean, there's a lot of talk of planning. Planning is obviously a challenge, but there are a lot of other issues that are leading to this low level of new housing construction we're seeing at the moment. Of course, at the same time, the federal government wants to build 1.2 million new homes over the next 5 financial years. I'm yet to come across anyone in the industry that thinks that is going to happen. And certainly it's going to be hard to make that happen with interest rates where they are at the moment. You can also see this playing out in dwelling commencements, which again are pretty much at decade low levels. So if you're not getting an approval, you're not going to be getting a commencement. But there's still a lot of housing under construction. And this is mainly because some of the projects that were halfway through have been abandoned, but also just building takes a lot longer now than it did before the pandemic because of material shortages, trade shortages. At the same time that we're not building any more housing, we desperately need more housing because over the past year, the population of Australia has increased by about 650,000 people. That's 2.5% annual rate of population growth. most of that is coming from net overseas migration, about 84% of it. If you're here, if you've just arrived in Australia, and most of the people coming in from overseas are students here temporarily, you're not going to be buying a house, or you're very unlikely to be buying a house. You're going to be renting. So this is putting a lot of strain on the rental market at the moment, and this is why we're seeing such tight rental market conditions. So let's have a quick rip around what all of that looks like for South Australia. So the unemployment rate in South Australia is 4%, bang on what we're seeing nationally. You can see the 30-year average unemployment rate in South Australia is higher at 6.5%, pardon me, than what we're seeing nationally. We have seen a decline in the number of employed people over the past year. Most of that decline has come from full-time employment. So the labour market has certainly weakened over the last 12 months. We're still seeing quite low underemployment and underutilisation rates, but you can see that they are trending higher. And we have seen that fall in hours worked in South Australia. In terms of new lending, so lending to subsequent buyers is up 12%, which is a more moderate rebound than what we've seen nationally. First home buyer lending is only up 6.5%. Again, a more moderate rebound in lending to first home buyers than what we've seen nationally. But investor lending is up 44.5%, a stronger year-on-year increase than what we've seen nationally. So investors are certainly coming back in to the South Australian market quite strongly at the moment. And we'll talk about that a little bit later. In terms of dwelling commencements, very similar story to what we're seeing nationally. Low volumes of new commencements. Still a lot of housing under construction, and that's because it's taking a lot longer to build. But that pipeline of new housing coming in behind has really thinned out. And then if we look at population growth, so there's three components of population growth. You've got natural increase, which is births minus deaths, and you can see it's still positive, but it's on a long-term downward trend. Net overseas migration has been particularly strong over the last couple of years, and that's true for any state or territory in the country ever since the borders reopened. Net interstate migration has really faded in South Australia. So if you go back to during the pandemic, there was more people coming to South Australia and fewer people leaving South Australia. That has now started to change, and we're starting to see an outflow of residents from South Australia, albeit it's a fairly small one. So where do we think the economy is going to go this year? On the right of this slide is the current forecasts from the Reserve Bank as to what they think, but a few highlights here. So we've only got economic growth data up to March. We think that it's going to continue to be weak over the June quarter, which we're currently about to come to the end of. Second half of this year, though, things will start to rebound, but I will say that I expect that economic growth is still going to be well below the long-term average. The reason for that rebound, more stable interest rates, easing inflation, but also the tax cuts that have been broadened. So more households are going to have access to those tax cuts, and that will probably drive more households to go and consume more than they have been over the last 6 to 12 months. Inflation, we are expecting to moderate further. As I said, headline inflation will probably dip back into the target range, but then it will bounce back out next year. It's probably not the conditions whereby the Reserve Bank would be cutting interest rates this year. We do expect that the next interest rate cuts are probably coming in 2025, probably a little bit earlier than what the expectations of mid next year were. I wouldn't be surprised if it's sort of February, March of next year. The labour market we expect to weaken further with the unemployment rate drifting higher. Some of the labour shortages will wane, but also the weak economy will see businesses slow their hiring intentions and reassess rehiring for roles when people leave the businesses. Wage growth, as I said, has likely peaked, but it is going to continue to be stronger than inflation, so real wage increases will continue. Housing construction sadly looks like it's going to be even lower this year than it was last year. So it's a really challenging environment to get new housing construction taking place, especially given that price premium is so large. And population growth has already shown signs that it's starting to slow, but it's going to remain well above long-term average levels and probably for this current financial year and maybe even into next financial year. It's going to be very hard to get population growth back down to where the federal government wants it to be. So let's move on to the housing market and what we're seeing. So over the last 3 months, we've continued to see prices rise. You can see there has been a slowdown in that rate of price growth, but certain areas in Adelaide and the Barossa, York, Mid-North, you can see quite strong price growth over the last 3 months. The exceptions obviously have been the Central and Hills, the Outback and Southeast, where growth is either more moderate or prices have fallen over the last 3 months. If we look over the past year, prices in Adelaide are up 14.5%. Prices regionally are up 11.7%. The more affordable northern suburbs of Adelaide have seen the strongest price growth, up 18%. Now, to give you some context of that price growth for Adelaide, prices in Perth are up 20% over the past year. Brisbane prices are up about 14%. Sydney prices 7%. Melbourne prices about 1%. So Adelaide is certainly one of the stronger performing markets for price growth across the country at the moment. If we have a look at houses versus units in Adelaide and then houses regionally, house and unit prices in Adelaide are up 14.8% and 12.2%. Regional house prices are up 12%. Some of the standouts: Adelaide North house prices up 18%. Barossa region house prices up 17%. Adelaide's western suburbs prices are up 15.5% for houses. So we are seeing strong price growth pretty much right across the board in Adelaide over the last 12 months. Units obviously seeing slightly weaker price growth, but generally still seeing strong increases over the last 12 months. Now, if we have a look over the past 5 and 10 years, so over the last 10 years, prices in Adelaide are up 94%, but 71% of that growth has come in the last 5 years. And you can see a similar trend that all of the growth over the last decade in regional South Australia has basically come in the past 5 years. And you can see there's areas there where prices have doubled in the last 10 years. The northern suburbs of Adelaide, the southern suburbs of Adelaide have seen more than 100% increase in prices over the past 10 years. So it's been quite a strong period of growth. Most of it, though, has been driven by the strength in the housing market over the past 5 years. And then this is just looking at the premium for house prices versus unit prices and also giving you an idea of what the median price is. So not surprisingly, the Central and Hills is seeing the largest house price premium. It's getting increasingly hard for people to be able to afford to buy in that location, given where prices are at the moment. Then I wanted to talk to you about what's happening with supply. And looking at supply, we talk about new listings. So the number of new listings coming to market in Adelaide has been very low for the last couple of years, but it has ticked a little bit higher. You can see the blue line there, which is last year. The last couple of months, new listings have been well above where they were a year ago. They're up 5% compared to a year ago. They are still down 2.7% compared to the number that they had on average each May from 2018 to 2022. Where have we seen the biggest increase? So you can see regionally, we're seeing new listings quite a ways up from where they were a year ago and above the 5-year average. You can see in the Central and Hills, a 13% increase in the number of properties on the market in May this year compared to last year, that new listings, sorry. If we look at total listings, though, there's still not a lot of stock for sale. When you start looking for properties, there's not a lot to choose from, and you're basically hanging out for those new listings. So new listings are down 9% from a year ago, and they're 37% below that average from 2018 to 2022. And it's a very similar story in regional South Australia as well. You can see those red bars there, the change from the 5-year average way down. So there's not a lot of stock on the market, and most of the buyers are hanging out for those new listings to come to the market. And sales volumes are quite strong. So the number of sales in Adelaide in May was 16% higher than it was in May last year. And you can see the only year over the recent time where we saw more sales in May was 2021. And you can see right across Adelaide, the number of sales is higher than it was a year ago. Things are somewhat different outside of Adelaide. You can see the southeast has seen an 18.5% rise in sales compared to a year ago, but the outback and the Barossa York Mid-North are seeing slightly fewer sales than what we were seeing 12 months ago. Then looking at our measure of demand, so the number of inquiries per listing. Now, remember, this is a function of both the volume of inquiry, but also the number of listings. Listings are down, so there's fewer listings. And the typical listing is getting more inquiries now than it was a year ago, 22.7 inquiries per listing in Adelaide, up from 18.6%, a 22% increase over the year. And in regional South Australia, things are marginally higher. It's the northern suburbs of Adelaide where we are seeing the highest number of inquiries overall, but generally right across Adelaide, you can see that there has been that uptick in inquiries per listing. So the level of demand for housing out there is still really strong. The biggest problem is the lack of supply of housing coming to the market or already on the market. And also, the motivation for that stock that is sitting on the market. Are people setting appropriate prices? Are they adjusting those prices to meet where the market's at? And then if we look at days on site, so days on site in Adelaide, 23 days, that's the lowest of any capital city in the country. It was 27 days a year ago. And again, if you have a look at that 5-year May average, we were looking at 44 days. So the market is moving much quicker than what we've been seeing typically over that 5-year period. So it shows you if you get your property on the market, you set a compelling price, or you're willing to adjust that price, you're selling those properties very quickly at the moment. So where do we think the market's going? So this is more general national talk about the market, but we'll talk through this, what we think in South Australia. So firstly, I think if we think of recent decades, housing price growth has been really strong. And I think there's been 4 big drivers of that. And I think at least 3 of them are not going to be as strong going forward. So that doesn't mean prices won't rise, but it means we probably can't expect prices to rise as rapidly as they have in the past. The first one is start of the 90s, interest rates were 18%. They fell to basically nothing. They've increased back up, variable mortgage rates about 6.5%. But even if that 6.5% fell back down to that 2% variable mortgage rate that we had during the pandemic, which I don't think will happen, it won't boost borrowing capacities anywhere near as much as that fall from 18% did. So as interest rates came down, borrowing capacities increased, people could borrow more, they could bid up property prices, and they did that. Credit is harder to get now than it was 15 years ago. It's not as hard to get as it was in the 80s. But if you go to take out a mortgage now, the lender wants to know, are you planning to have kids? How often do you travel? Do you have Netflix or other streaming services? It's quite intrusive, and it never used to be that way. You've also got the banking regulator, APRA, who stepped into the market and changed serviceability buffers. For a time there was limits on credit growth to investors and interest-only borrowers. And again, I don't think that's going away. And then you've got employment participation. As I mentioned earlier, it's pretty much at record highs. One of the main drivers of that has been more women joining the workforce. So as more women have joined the workforce, household incomes have increased. People have been able to borrow more money for housing, and they've done so. Again, we're probably at the point where employment participation is not likely to go much higher than it is. So you're not going to get that boost to borrowing capacity. And then the one that's becoming more and more contentious is migration. And, migration has been at high levels for, several decades. Migration initially drives a lot of demand for renting, but longer term, as people decide they're going to stay here, that drives more demand for housing to own as well. So I think 3 of those 4 are not likely to be as strong going forward. In saying all of that, the level of demand for housing right now, particularly in South Australia, is surprisingly strong, especially when you consider where interest rates are, highest in 12 years, and also how quickly they got there over the last couple of years. And that in 2022, when they were starting to rise, how much the housing market weakened. But even though interest rates have gone higher, we've seen even stronger price growth over the last 12 to 18 months. We have seen that marginal increase in the volume of new listings coming to the market. And even though that's happened, we've continued to see price growth accelerate. We think that prices will rise at a faster pace this year than they did last year. Where we are seeing more stock coming to the market, though, people need to be more realistic on price. Now, this is not so much of an issue in South Australia yet, but we're certainly seeing it in a lot of other parts of the country that there is a mounting amount of stock, particularly in places like Sydney and Melbourne. I think the general gist of what you need to be saying to vendors, though, is you definitely need to be more realistic on price as there's more stock coming to the market. We talked about the high cost of new housing, and that's likely to see people preference existing homes. I think that's going to continue. It's also likely to see people preference homes that aren't in need of a renovation, as opposed to those that do need renovation, because it's so hard to get a tradie and it's very expensive to undertake those renovations at the moment. We need more infill housing, probably not as pressing in South Australia as it is elsewhere, but generally speaking, we need to deliver more housing in those established suburbs, but there's a lot of political and financial hurdles to overcome. I do think, and we're about to go into the rental market, but the high cost of renting is likely to see more of those people that are renting, that have the capacity to do so, to become first home buyers, just because, yes, it's going to cost them more, but they want that certainty that they get with owning their own home that they just don't get in the rental market at the moment. So let's have a look at the rental market. So over the last 3 months, house rents in Adelaide rose another 1.7%. They increased by 4.2% for units. Adelaide's western suburbs and Central and Hills, you can see median rents now up above $600 a week. And we've seen some quite strong growth in just 3 months. If we look over the last year, Adelaide rents are up 10.2%. Regional South Australia rents are up 6.7%. Interesting fact, the median rent for Adelaide property is the same as the median rent for a Melbourne property nowadays. It's still cheaper than most other capital cities, but interesting that it is the same price as Melbourne. Again, Adelaide's northern suburbs, probably not where you would think that is necessarily the most desirable of locations to rent, particularly if you're talking about a lot of international students coming into rent. But it's seen the strongest increase in rents. And this is a phenomenon we've seen right across the country, that it's not the inner city areas where you would usually go, okay, that's where renters want to be, where we're seeing the strongest rental growth. It's, slightly outer areas. And I think the cost of renting is pushing people into less desirable locations to rent at the moment. And you'll see this as we go through with inquiries and listings, also similar trends showing that as well. Over the past year, house rents are up 10%, unit rents are up 12.5%. There's still a $100 per week gap between house and unit rents in Adelaide, and a $100 gap in regional South Australia as well. Adelaide's northern suburbs, a 16.5% increase in unit rents, 14.3% increase in Adelaide's western suburbs. So you can see things are a bit mixed depending on where you are. If we have a look over the past 5 and 10 years, so over the past 10 years, 72% increase in advertised rents in Adelaide, 56% of that growth in the last 5 years. 60% increase in regional South Australia, with 53% of that growth coming over the past 5 years. So that's really strong rental growth, particularly over the past 5 years. Again, have a look at Adelaide's northern suburbs over the decade, 83% increase in median rents in that market over that period of time. So very strong rental growth. We are seeing, though, that a bit of a moderation in the rate of rental growth, and price growth is still really strong. So we're starting to see rental yields dive a little bit. And actually, in South Australia, rental yields, particularly for units, have been heading lower for about 2 years now. Now, they're still generally much higher than what we're seeing in most other capital cities. But if you're investing for yield, maybe South Australia is becoming a little bit less attractive, but you are still getting that rental growth and that price growth, which certainly makes it attractive for investors, particularly if you're coming out of Sydney and Melbourne and looking at what a house or a unit costs in Adelaide or South Australia compared to what it costs in Melbourne or in Sydney. And then if we look at rental supply, so there's actually been a bit of an increase in new rental listings over the last few months. You can see they're 10.5% higher than they were a year ago, and they're actually now above that May average from 2018 to 2022. Still not a lot of new rental stock coming to the market, although there has been a bit of a surge in Adelaide's north and west over the last 12 months. If we look at total rental listings, though, again, higher than they were a year ago, but still very low, 18% lower than that 5-year average. So it's still quite a tough rental market in South Australia. If we look at rental inquiries per listing, they are down from a year ago. Now, they're down in pretty much every market across the country, but you're still looking at about 31 inquiries per listing. Before the pandemic, you were looking at about 22 inquiries per listing. So we're still seeing that heightened level of demand. In regional South Australia, you can see that inquiries per listing are also lower than a year ago. And if we look in the individual regions, there's been a big pullback in inquiry per listing in the northern suburbs, a more moderate decline in inquiries per listing in the other parts of Adelaide. Vacancy rates have trended a little bit higher, but they're still very low on a historic basis. Again, just reflecting that very tight rental market that we're in at the moment. And then if we look at days on site, so it's 19 days on site typically at the moment, 17 a year ago. The 5-year average is about 21 days. So, properties are generally still leasing very quickly throughout South Australia at the moment. So where do we think the rental market's going to go from here? So there's a few things that are really driving the increase in rents in across the country. Household sizes shrunk during the pandemic, and that's because people didn't want to live in share houses, because rents in inner city areas became really cheap, so people left share houses and went into those. We have started to see household sizes increase again, although that has stabilized over the last 6 months or so. If you've got a smaller household size, you need more households, especially as the population is rapidly increasing. We're seeing very low levels of new housing construction, and we've talked about that. You go back 10 years, a lot of new housing construction was actually catering to investors who were then making that property available for rent. A lot of the housing construction these days is targeted at owner-occupiers, so you're not getting that growth in the rental stock. And at the same time, we've got a rapid population growth, mostly from migrants that need somewhere to live when they get to the country. So rents have increased rapidly on the back of that over the past year, but increasingly a challenge we're hearing is the capacity to pay the price that landlords are asking. Now, I still think rents are going to continue to climb, but I do think that the rate of growth in rents is going to slow just because people don't have the capacity. Their wages are not keeping up with how much rents are increasing. And how do people respond to this? They move to a less ideal location. They move into smaller properties. So if you're in a house, you move to a smaller house. If you might move into a unit. Or what we're increasingly seeing, probably not out of want, but more out of necessity, is more people are moving into share houses, just as a means to actually find somewhere to rent and be able to afford to pay the rent. How do we address this? So the problem in the rental market is both a supply and demand issue. So on the supply side, what can we do? If we fixed everything that was stopping new housing construction today, it would still take 3 years for those homes to show up. So we definitely need to address supply, but it's not the quick fix. Probably the quickest fix is trying to get more people investing in residential property. Which is easier said than done. And in some states, luckily not South Australia, state governments are putting more and more taxes on investors, which is discouraging investment from those states. On the demand side of things, what can we do? Lower migration. That's really difficult to implement as the government's actually trying to do a little bit of that, but finding out. The last 2 budgets increased Commonwealth rental assistance. We could do that as well. That was after 20 years of not adjusting rental assistance, so we could probably do more of that. Or the other one is trying to encourage more people to exit the rental market and become first home buyers. And as I said earlier, I think we will see more of those people renting become first home buyers over the next couple of years. But also I think we'll see more investors coming into the market because the capital growth is still strong, the rental growth is still strong, and there's no meaningful increase in supply of housing coming. So it's going to tick a lot of box for rental investors for the next couple of years. So that's the end of the presentation. What I'm going to do is stop sharing my screen and see if there's any questions to answer. It doesn't look like we've got any at the moment. If you do have any, feel free to quickly type them into the chat or the Q&A. Give you a minute or two. If not, please reach out to your account partner, and then we can ask them. They can ask them to ask me, and I'll try and answer your questions. We've also got a poll that's going to jump up in a couple of minutes just to get your feedback on these presentations, and see if they've been useful for you. We will also have a copy of these slides made available to you after the presentation today. All right. Okay. Seems like there's no questions. Hopefully that was useful for you. And hopefully you can, take some of the insights we had here today to have those better conversations with your vendors and your potential buyers and sellers. But thanks very much, and I hope you have a great day, and good luck selling properties and renting properties over the next few quarters.